Traders, investors, and peeps, what is going on? We are back. Now, got some different stuff and things. Hopefully, this video doesn't get taken down. I reached out, asked for permission. We'll see what happens, but I watched this webinar, and there's some gold in here, man. I don't have any problem sharing with you, stuff and things from other peeps, because at the end of the day, I am a greedy man, but I'm here for y'all, right? I just want everyone to do good. I want everyone to grow with me, right? So, happy to share gold from other content creators, other people. Just want to give you guys all the stuff and things that I can possibly offer that would be helpful. So, that said, I will try and give some helpful timestamps in this to make this a little bit more digestible. It is very long, but I'm telling you right now, there's a lot of good information in here. Stuff and things that I wish I knew when I started out, and I think she does a great job laying it out in a formal way, so hats off to her. And yeah, had to share with the peeps. So without further ado, let's jump in.
Day trading and learning process, I quickly realized that, following alerts never worked. It might work once or twice, but it will never work consistently. And while the times where they would work, you'll make like $100, $50, $200. But when they don't work, I'll lose like $500,000. So I would say this is something, if you're going through this as a beginner trader, it is very, very normal, right? But at the time, it just feels like the worst thing that could happen in the world. But with my little $7,000 account, I'll lose like $100. Well, I made $100. I'll lose like $300 or $1,000. And then the days where I make money, it'll be like 100, sometimes 200. So definitely a lot of small wins, and the losses are bigger because you're just following others. You're not, like planning your trades. You're not doing the studying. I wake up 10 minutes before the market opens to try to like click buttons. So my year one, I was like all red. From chasing alerts, trading other people's ideas. Like we said, the wins were small and the losses were much bigger. So I stayed in a chat room to read other thoughts process. I sized down and I started viewing the small losses as market tuition. I actually sized down a lot more. I was trading with like 10 shares, 20 shares. After the initial failure, I finally realized, okay, if I'm gonna, keep on losing in order to learn, then I want to make sure I'm only paying like $10, $20, $50 a day tuition. So I think that's a really important pivot point that a lot of traders, especially if you're new entering the market recently, and you're frustrated after a month or two, you're not making money yet. I think that's very normal. And like I said, I didn't make any money at all in my year one. So it's a learning process, and you have to pay those upfront tuition. You have to do that. If you don't, you're gonna owe the market some money eventually. Let's say everything worked out for you for the first 6 months. You're gonna owe that tuition, because if it's based on luck, if it's based on following alerts, at some point down the road, that's gonna change. And when it changes, you're gonna be humbled. So I learned that really fast, that what worked for others didn't necessarily work completely for me. And that's the reason alerts didn't work. But what you could do is, take what you learned from the thoughts process, from reading others in the chat room, from others sharing their ideas in the community, on YouTube, etc. You can take what they're teaching you and make them your own, right? You have to personalize those setups to make them fit your personality, to fit your trading style, your patience, and your risk tolerance, especially. That's the most important one. Learning how to trade will make you money, but learning how not to trade will save you from big losses. So I think that's a very important aspect that we're also going to cover. You have to learn how not to trade. You have to learn for yourself that how to control your emotions and your discipline, because those are the things that are going to save you from big losses, right? Learning to make, I would say, at this point, that it's not difficult to make money from the markets, but it's very hard to keep it, because we're all human. We have human flaws, and that makes us do stupid things sometimes, and I still do them, even after so many years. So a big turning point during my learning and failing of the day trading journey is that I finally, I'm just checking my candles to make sure we're not setting the room on fire. Okay. Well, a big pivot in my trading journey is that I started making my own plans and taking risk management very seriously. That's at some point you have to do that for yourself, because if you don't get to point number 7, you're gonna circle around 1 to 6 for like months and years until you really consciously start doing number 7 and start taking risk management seriously. Especially your account will not grow until you manage the one thing you could control, which is your losses, because you cannot control your wins in the market. So no more random trades, no more I hope this works, I hope this stock continues going up higher, no more. If I ever have to say I hope or I wish in a thesis behind my thought process in a trade, then that's a no trade for me. No more of that. And no more, let's see what happens, right? What's the worst that can happen? No, I'm gonna buy 2,000 shares of this penny stock overnight. What's the worst that could happen, right? I hope this works out. And most times when I have to say that, those trades never work out. So like I said, in year 1, I was all red. In year 2 was the year I finally broke even and started, finally know what I'm doing. I'm not saying like I started making big money right away, but at least I was break even and starting like there's a apparent consistency and there's a pattern in my own trading behavior and my own discipline that I can fall back on. So in year 2, I broke even. And now 6 years later, this is from which month? October of this year, October 2010. The 6 years later, I'm making consistent profit from the market, opening balance, ending balance from one of my trading accounts. The other one is also in October. My other trading account, this is starting realized P&L, ending balance. October, that's my other account. November, this is November. Yeah, this is November. So these are my 2 main trading accounts. So we started balance, ending balance. What was I saying? November, center point, starting balance, ending balance. So this didn't happen in year 1, year 2, or year 3, right? This happened 6 years later. So, and you guys remember the tiny, the small profits, the bigger losses. Now, I still lose. You guys know, like I still lose money. But now, if I'm down, I don't go down a slope of consistent red days. Right now, I have the discipline, I have the discipline, the rules for myself to make sure that, even if I'm down from 1 day or sometimes 2 days, unfortunately, I can keep my P&L trajectory to steadily up. So this is in current month, December 2020. I still take, decent red days. This day was not fun, definitely not, but I'm able to come back. And this is just kind of show that, it's red days are normal, right? As a trader, you have to take red days, but it's how you come back from that. Afterwards, the days after, that really determines whether you're gonna stay consistently profitable or whether, you lose 1 day and then you just steadily blow up the next few days. So, but this is after 6 years. This did not happen in my first year or second year. Okay, so that brings us to today's topic. I really want to talk about this point here, but let's kind of go over why do 90% of all traders fail. I didn't come up with a percentage, somebody else did, but I believe it. I can see why 90% of all traders fail. There's some reasons came up to mind. They can't control emotions, ego, greed, chasing a dream or get rich quick, which is also how I started. So, I think it's normal for most people to start with number 2, that you want to get rich quick, but you have to snap out of that at some point. to, because if not, then I'm gone, right? No risk management, which is also very important. That's risk management and trade planning are the two things that really started to pivot my trading journey. Not like right away, not like a 90-degree turn right away, but it started a process, right? But today, what I really want to talk about is number 4. 90% of all traders fail because they spend 90% of their time chasing 90% of all hot stocks out there. And that's what I really truly believe, right? When people feel overwhelmed, it's because they're trying to watch 90% of the stocks that's gapping up on the day. Or they're trying to spend 90% of the time, flipping to, different tickers on their broker platform, just trying to find a trade. That's what failing traders spend most of their time do. And they only spend 10% of their time watching, the 90% of the time is clicking buttons, trying to find the next trade. Now, for profitable traders, for consistent traders, it's the exact opposite, right? We spend 90% of our time watching and waiting, and only 10% of the time executing the trades. So that's the biggest difference that I see after so many years of trading. From a failing trader, comparing a failing trader to a profitable trader. So that's kind of what I want to talk about today. Random stocks lead to random setups, which leads to random trades and random results. And that's why people will have these kind of P&Ls when they're first starting out. And that's normal. I went through that too. I'll be trying to chase these random stocks. And of course, they'll work on some days and you'll feel like really good. You're making money, $200, $500 a day. But on the days where it doesn't work, when chasing random stocks don't work, it's like, it's not consistent. So that's why it's important to narrow down the stocks we watch, the stocks we trade, and the setups, right? Like we mentioned earlier, you have to narrow things down, right? Instead of watching 90% of all the stocks that's gapping up, you need to be watching less than 10% of it. So that brings us to data tracking, which is very important. It's just a fancier way of typing crap up in Excel and you write numbers in it. You want to track two types of things. Track your setups, the stocks you trade, the setups that you take, and also you want to track your own trading behavior. Because one thing, the number one, you're tracking what works for you in the market. Number two, you're tracking how you behave while you're trading in the market. So both of these things I think are very important. But the first one you always want to start with is your setups. Your number one, your trading setups. And these are just some sample images of how you can track it. Setups, maybe these setups, you have 1, 2, 3, 4, 5 setups. You track them, you look at your win rate, you look at your P&L, and you can look at the number of trades you take per setup. And you figure out, okay, what are the top 2 that's working for you? Because you only want to trade, obviously, the ones where you have higher amount of win rate and also that you're actually making money. You don't want to trade the setups that you're losing. I mean, I don't have a good example here, but like down here, you can do this on the bottom one on Trader View. You just tag your trade setups, and then you can see from this setup number A, you don't want to trade that because this one, this person does terrible at it, and that person is me. So I should stop trading setup A and focus my time on setup B and setup E, right? You want to start tracking, do you do best at buying breakouts or buying the dips, right? If you put those two setups separately, for me, I would know that when I buy breakouts, my win rate is like 10%. But when I buy the dip, the win rate goes up drastically. And also you want to track whether you're actually making money, like risk reward wise, are you losing more or are you making more from this one setup? So that's very important. You want to track your setups. And number 2, you want to track your own trading behavior. And we'll go over that in a little bit. Okay, so, we talked about that we want to track those things, but what exactly is a setup and what is a strategy, right? Because those are the things that we kind of talked about in a previous slide, these things, what is each one? Like, what is it? Scalp short, what is that? Mid-day squeeze, what is it? So you need to define that. You need to, you're kind of starting out from the bigger picture, right? You have all these setups, 1, 2, 3, 4, 5. But for each one, you want to go in and define that and find out what are the specifics for that setup, right? It cannot just be, oh, if it's up 20% or 60% on the day, it cannot just be that. So your first of all, your setup and your strategy should never contain hope or luck. Like you cannot put money on luck, on saying, okay, this is a setup A if I'm lucky. It doesn't work like that. That's the most important part. Trading is an art, it's not a science. Nothing is 100% guaranteed to work. But you have seen, you must have been inspired or by recent, let's say chart breakout happening repeatedly with similar stocks. For the example we're going to talk about today, we're going to talk about Disney stock breaking to new all-time highs in December, and we'll going to talk about Snapchat, another stock that broke out to new all-time highs in 2 months ago, October. So this is kind of just talking about where your setups should be inspirations from. So these are recent market inspirations for our strategies, and it's one of the setups that I really like to take. And from there, let's say, I'm starting out the setups completely from scratch. I saw Disney charts, I saw Snapchat chart, and I've seen a lot of similar charts like these in the past before. So you kind of want to start from what you've seen working, and you work out backwards. You take a look at those stocks, right? For example, like this is the stocks that we're talking about, right? Disney, this is like a week ago, stock broke out to all-time highs. Let's say from this chart, we're very inspired. We're seeing that, okay, like this is, 165 all the way to 178. This is like a good 5%, 6% move. I'm trying to do math really quick, something like that. And I just want to, let's say, I'm a new trader. I just want to catch a piece of it, maybe even just $2 of it. Now we're looking at the charts. You're saying, okay, like, I wonder if there's a setup I can capitalize. And you look at Snapchat, you look at it and you see that it's the same way. Let's say, oh wow, this is such a strong breakout. I really want to capitalize on this too. And this looks similar to the Disney charts that we saw earlier. Or you saw Disney first and you look at Snapchat, you're like, okay, like these two are very similar. I wonder, these two breakouts are very similar. How do I get a piece of it? How do I, work backwards to create a setup for myself that I can trade in the future, right? You're using past chart breakouts, past chart inspirations from the market to kind of make plans for the future. What was I saying? Okay. So you saw those charts. Now we wanna go work backwards and find out what exactly happened on those days that they broke out. Fundamental catalysts. What do they have in common, right? Do they have news? Do they have earnings? Is there like a new partnership deal with Amazon, Roku? Like, well, what cost? What's the fundamental catalyst that caused the breakout? So that's important. And we also want to look at the technical analysis, right? What do the charts have in common? And, I always start from the daily chart. What does the daily chart look like? What is the, what is the key resistance to break? And how many percentage was the run after that breaks, right? Does it keep on going for multiple days? Maybe we're trying to figure out a swing trading strategy here. So you always have to start with what's already happened and what you think would continually to happen repeatedly in the future. Maybe not every single day, but you see it enough that you can work backwards. You have enough sample sizes of stocks to work backwards for. So for this example, Disney and Snapchat are the ones that we're going to take a look at. We want to first of all figure out the fundamentals and the technicals. what do they have in common? What do the fundamentals have in common? You want to figure out all these things, and then that's how you can kind of create a more concrete trading plan for the future. So this is what the chart looks like. You can see the stock was trading at all-time highs. It basically gapped up. I guess on this day, gapped up to around. Can you see that? Annotate, highlight. Oh, there we go. Okay. You can see the stock basically gapped up. Gapped up to all-time highs pre-market on this day, and we can take a look at, okay, this thing, you can see it dipped at the market open. This is also pre-market lows, right? Very simple pre-market lows area, the rough area around what I want to say 165. It dipped down to, it spiked in the morning, yes, quickly, but we had a tiny profit taking. These are 5-minute candles. The profit taking for the first 5 minutes, and you can see once after 5 minutes of the open, 9:35, we had the first green candle, and the thing just kind of reclaimed this VWAP, by the way, this pink line, reclaimed VWAP, and then on the 5 minutes, it never pulled back down after that. Okay, then we can kind of think, okay, so if we're expecting, stocks, that have similar news as Disney, which at the time was that they have a new, I forgot. What was the HBO partnership? Oh my God, it was only a week ago. It was a fundamental catalyst. Disney, was it like, oh yeah, they're projecting more revenue to their the online stream subscription service, right? The Disney Plus, yes, more revenue, more subscription numbers, future projections for the company, the earning projections for the company is going to be increased drastically in the future. So stock gapped up to new all-time highs. So that's the fundamental reason. Now the technical part, you can see we dipped to pre-market support level, this rough area, and the stock just climbed back over VWAP, broke out above the high of the day breakout. You can see we broke out, we dipped to the high of the day area, and then we go up higher for like the rest of the day. So that's like about 8% move, we said. So, that's the first observation from the stock. So, from that, we have gathered the fundamental reasons and the technical analysis part. Now, let's take a look at Snapchat, right? You can see, something similar. And obviously, I know we're just doing 2 examples here. Now, in October, it was, if you look at this chart is Thinkorswim. On this day, this icon means they had earnings and guidance. Really the quarterly earnings report. So on this day, I remember it was earnings beat, revenue, earnings per share revenue, and also guidance up. So, similar fundamentals similar fundamental news catalyst as Disney, right? The company is projecting increased revenue for the future quarter. So this thing, you can see very similar chart. We have, first of all, similar fundamental catalyst, and the charts gapping up to new all-time highs. Gapped up here pre-market to 35 from a close of $28. That's a very significant gap. But you can see, pre-market we sold off some, to some pre-market support right here. At the opening candle, these are also 5-minute candles. We had a spike. We dipped a little bit. These are tiny dip levels around 34.50. Right, made a dip, didn't touch exactly to the pre-market low levels, but you can see it dipped, broke out above the high of the day after that first 5-minute dip, and then we just climbed to new highs. I would say this is another Snapchat. This is how many percent? 10%? Yeah, that's 10% of the move. If you do the math, 35 to 38, that's 10%. Something like 9 to 10% of the move. So you can see a similar setup here. I was saying something similar. And that, even though I only have 2 examples here, if you just go do some homework after this presentation, you'll find very similar setups, very similar charts with these larger cap stocks. So, the setups has to always be inspired from usually recent charts. So that's kind of what we were doing, right? We looked at the fundamentals, we looked at the charts, they look similar, and we worked backwards to create a setup. Now, what I don't want to do is kind of like this. The fallacy of using too much data tracking without a thesis, right? You always need a thesis first. This is something that that I worked with another trader that I worked with regularly. He would make these really fancy looking spreadsheets, and then I'll look at it, but I always wondered, like, what exactly are you tracking this for? Are you gonna use this to make a setup of your own, or you're just tracking this for fun, right? You're tracking all these things, which is good, right? The floats, the ticker, the date, day one news catalyst, previous day close, pre-market high, all these different levels. Like, you it's good to track these things, but unless you're actively using them for a setup that you're working on, you're kind of just, like, can you generate anything in common from this besides the fact that lower float stocks and spike? That's the only data I can see from this tracking sheet. So that's the reason you always want to start with thesis. You don't want to just be tracking everything for the sake of tracking because, oh, you saw somebody on YouTube tell you to do that. You saw humble traders say track your setups and you start doing this. You should be, but you want to track with a thesis. You don't want to just track anything random, right? This kind of just looks like the lower float stocks with the COVID news, in April, May, they spike, right? Unless you can see something else from this data sheet, to me, this is useless. And I worked with him on this thing. I'm sure he, I don't know if he's actively using this now, but to me, I don't see anything, right? And it has to be something that you can see. You have to start with a thesis, and that's why I'm a very visual person, and that's why I always start with the charts. The charts that we talked about earlier, that's how I personally do it. Maybe you look at this data sheet, you can just see these charts in your mind, but I can't. So everyone learns differently, and you have to find out what works for you. But I get a lot of questions from traders, sending me these Excel sheets, sending me these journals, and ask me, Shay, do you see anything from this? And the answer is no. So I don't see anything here. And that's just me, right? I learn from the setups, from the charts I actively look at every single day, and I work backwards to get the numbers I need. So that's just kind of the process of how I look for setups. I don't start with this thing. I start with a chart, right? Maybe if you go in and look at these charts, all these tickers, maybe you'll see something. Maybe you can find a commonality there in like we talked about earlier, the fundamental catalyst, the technical chart, how the charts are setting up, the technical analysis aspect, and then you work backwards to create a setup for yourself. Okay, so from continuing from what we talked about for Disney and Snapchat, that's our setup, right? How do you create a trading plan around that setup? Again, hope and luck should never be part of the plan. If that's part of the plan, the plan is probably gonna fail. So the trading plan should have the following things according to the setup, right? Everything is centered around the setup. The setup is that what we saw earlier, the thesis is that large cap stocks with positive earnings projections should break out higher. That's what we saw earlier on the past, only the two examples that I brought out, Disney and Snapchat. Okay, so we saw that. Now we kind of take a look at the technicals. How is the chart setting up on the daily and intraday, right? It's the stock is breaking out to all-time highs, right? That's the setup. That's how the chart is setting up technically. Now fundamentally, they have positive news, positive earnings projections. So that's the fundamentals. Entry, we saw that earlier. Pullback after pre-market high breaks, or this or dip to pre-market low support, right? That's kind of what we saw earlier. When I went over, I drew some ugly drawings around the pre-market levels, the top of the pre-market levels. You can see pre-market. This is, like it's pre-market low right here, pre-market highs, right? Those are the two levels that we're using for our setup example here. Those will be the entries and the exit. Exit in the profit taking, we saw we can make about 8 to 10% only if the entire move is captured, right? But even if you don't, you can still capture maybe a point or 2 points per share. So that's kind of like what we're looking at for the setups. And the stops will be the breakdown of pre-market high support or pre-market low support, depending on your entry. That's kind of what we saw earlier, right? The stock dipped to pre-market low level on the 5-minute chart, and then you just reclaimed higher, broke out about pre-market highs, and just climbed up all day to 6% to 10%. So that should be this is like the simplest trading plan that you should have for yourself. A thesis, a technical chart, a fundamental, for me, that's very important. There's people who can trade without the fundamentals, and that's fine. But I think these are the bare minimums you need for your trading plan. You need an exit, you need an entry, you need a stop, right? Stop as in you're planning out your risk. You're prepared for, let's say, if Disney falls off the bottom, I'm only gonna lose, let's say, $100. That has to be planned out. So it has to be as specific as you could. And that's also the reason why people like indicators. Indicators like those MACD, RSI, and all that stuff. That's the reason people like them, because if they give you like a definitive answer, right? If you put in, let's say, including all these things that we just talked about, let's say you use, RSI at 20, that's where you go long. Let's just say that. I don't do that. That's just an example. That's a reason people like it, because you can line up so many different factors besides just the entries, the exit, and the stop, right? That's the reason a lot of people like to use VWAP. I use VWAP, not for the entries, but I use that as part of my trading plan, as part of the setup, right? It's another one of these criteria you can add for yourself. So the more specific you can make for your trading plan, the more precise your entries, your exits, and how you select the stocks would be, right? Well, no longer, by having these things, let's say if you add another few indicator to part of your setup, by having all these things, 1, 2, 3, 4, 5, 6, 7, 8, let's say you have 8 different criteria for the setup, right? This stock that you're selecting to trade on that day is no longer part of the 90% of all the stocks gapping up, right? Because you're specifying, you're narrowing down the stocks that you're trading on the day. I would argue it's less than 10% of the stocks that's tradable on the day with volume. So you're narrowing down your focus. That's what we're doing. You're narrowing down your focus. You're isolating the stocks that fit your setup. And this setup, if you were tracking, like we talked about earlier, this setup should be the ones that can give you, at least 60, 70, 80% win rate. And that's how you narrow down the stocks you trade. You're no longer trying to trade random stock that's just popping up on the day, because those will be the ones, I guess I don't have enough examples here. Those will be the ones that will give you random win rate. And because those setups are random, you don't have the specific criteria that we just kind of talked about. So that's how you avoid random results in trading. You want to narrow down the stocks that you're putting your money into. This is your hard-earned money. You don't want to just throw it into anything that looks good on the day, right? You want to respect your money. So, by having the specifics listed out and planned out on your platform before you enter your trade, you're doing what the 90% of the traders don't do, right? Most of the traders, they follow chat room alerts, unfortunately. They have a scanner and they just jump into whatever is popping on the scanner, right? That's not enough of specifics for you to consistently make profit on. So you want to spend 90% of your time planning for your trades, for the setups, waiting and watching, and less than 10% of You're spending 90% of your time waiting and watching to trade less than 10% of the stocks in play that they just set up. Right? Instead of spending only 10% of your time planning and 90% of your time clicking buttons, you need to do the opposite. You need to spend more time watching and waiting and planning, and only about 10%, actually executing your trades, long or short. So that's a very important part. And this is something you have to actively and intentionally do to kind of stop, to kind of try to make that transition. Like, it's not something that you're gonna one day magically be able to do. This is something you have to actively train your mind and your body to stop jumping onto every single stock that's popping on the scanner. You have to do that, because either you do that, you force yourself to do that, or you lose all your money before you hit that point. And that's just a reality. I think most people eventually, if you trade for a year or two, you start, hopefully for most people, you're gonna start finally realizing that chat room alerts are not gonna work. Just jumping onto anything and everything on scanner is not gonna work. But you need to wake yourself up. You need to wake up, and you need to actively try to transition into doing these things that doesn't look fun. I'm sure a lot of you are falling asleep right now because, oh my God, it's like a lot of these things, a lot of extra steps that I have to do before I even enter into a trade. But you have to do this. I mean, you don't have to. I have to. If I don't do this, then my account's not gonna be too happy. But these are the things that I do for myself, and these are the things that's been keeping me consistent. And I did none of these the first year. I can say that. I did none of this, and that's why I was in deep red. I was just clicking all the buttons and thinking I can make money. Nah, it doesn't work that way. So these are just some recent executions I did on that setup. Exact same setup that we just talked about, right? This is not the most like the setup I just showed as an example. It's not rocket science, right? It's pretty basic, I would say, but it's simple, but it works really well in the market. You can see, BA, I forgot what, I think it's last month, had the similar fundamental news that we talked about. The stock, had a tiny dip to pre-market levels and just reclaimed the high of the day, pre-market highs. And pre-market high, pre-market low, exact same thing we talked about. I don't have the daily, but if you look at the daily on this day, you would see something similar. And the stock just went up to, from 229 all the way to 230s, 240s. So, 239, 240s. So exact same setup that I showed earlier on Disney and Snapchat. And this is just an execution of that 2-minute chart. Okay, next, similar one, Baidu, which we traded last week. This is an uglier chart, but if you look at the stock on the daily chart, this day right here, this day, this is the day I traded it. And then, very similar thing, right? This is at the open, spike, dip, I got in long, longed and added more on the way up and sold into the pushes. So it's an exact same setup, exact same execution. And these are the things that's repeatable for yourself. And the reason I can execute them the exact same way is because I've seen the same setup over and over again in the market, right? And that I'm just, at this point, after so many years, that setup is like ingrained in my mind. But so that's why, this is actually one of my favorite setups. And I still trade them every single, or maybe not every single day. But I would say there's very constant opportunities like these. And this is something that I've traded. I have enough sample sizes and enough screen time experience to see this setting up, and also to execute this trade. But this is not something you're going to magically master within a week or 2 weeks. It's something you have to actively practice and trade and collect enough sample sizes. Okay, just keep going here. Marna, another example, another long trade. I shorted at the open. Shorted right here, covered, reshorted some. The short was a loss, and then I went long and finally did better. Long, same idea, right? You can see this one actually never dipped to pre-market low level, but it broke out right away. I got long and then sold into the pushes. But it's a very similar setup. If you look at the chart, if you look at all the tickers I mentioned earlier, the chart looks similar. Intraday and also technicals. Intraday and daily, and also the fundamental catalysts we talked about. Okay, so you want, that's what we said. You want to start tracking and back testing your setups. You don't want to reinvent the wheel, right? You can start with proven inspirations from the market, proven setups. Like we said, with the thesis, and learn from experienced traders. But you need to personalize their setups to fit your own style, right? What I talked about today, you could trade that, but you probably need to go in and fine tune it to fit your criteria. Like maybe use the indicators we talked about, so you can add those to part of your trading plan, your trading setups. After enough sample sizes of 2 weeks of trading daily, you should see enough data on your setup performance. So earlier that the large cap breakout setup, let's say it's this setup here, right? Let's say you want to start tracking this specific setup along with everything else you're trading, and you want to see the results, right? Let's say for this setup, I only have 45% win rate, and the sum of profits like this, relative to the rest of the setup. You want to start figuring out what you should focus on every single day. You need to improve on the best performing setups for yourself. You can, how do you backtest? And backtesting simply means going back in time to practice the same stocks that we talked about. Let's say, after today's conference presentation, you go and look for more similar stocks that, you saw Shay showing Snapchat, Disney, Baidu. What are some other similar ones? You can go back and practice. You could use DAS Trader Replay. They have that option for, going back and practice your executions. Basically simulator backtesting, right? Or you can use Thinkorswim On Demand. They have a similar feature. It's a little bit more buggy and slower, but you can also do that on Thinkorswim, right? You can pick the dates. Let's say you want to trade Apple October 29th, 2010. You could go back and do so. So that's what these two tools you can do to backtest your strategies. You need to go back and practice the execution. Save the charts, print them out, and annotate them. Okay, so that's important, right? You want to track your setups, right? That Disney and Snapchat setup could be just setup A, right? And that's one of the setups you're tracking, right? You're tracking this you just want to track these enough to see what works best for you, right? It could be setup A and B, or it could be setup A, B, and E. And A, you should just completely avoid. You want to stop trading the worst setups with the lowest success rate in the P&L. That sounds like a no-brainer, but a lot of people still do it. Like I used to buy these like breakouts, as you guys know, buy breakouts on these low float stocks. Until I really tracked it, I realized, oh my God, the win rate is only like 40% when I buy breakouts on these low float stocks, and overall I'm net negative on the setup that I'm trading every single day. Buying at $1, sell at $1.50. That sounds simple, but the risk is higher than the reward. So I stopped doing that. And that has helped a lot. Remember what we talked about earlier. Learning to trade will, sure, make you money, but you need to learn how not to trade. That's also important, right? And that's why we need to also know what setups we should avoid. The ones that's making you or I red. So setup A, I should stop doing it. Right, that's the sort of things you need to track. How not to lose money. That's just as important, if not more important, than how to make money from the market. Okay, so we talked about tracking the setups, tracking what works for you in the market. Now you also need to track your human behavior. That's very important. You need to create enough rules based on your own behavior, since trading is 90% psychological and 10% technical. So we're human, right? We do stupid things as human beings. So you need to create a list of must follow rules to make sure you can intentionally control 90% of all actions. Because unless even you could have your setups down, but if you're if you're reckless, if you trade on emotions, it's very easy to kind of steer off grid, off rail, steer off rail from your trading setups. Track your behavior just like your setups, right? Make them separate. Start tracking stuff like what time frame do you make the majority of your profits, what time do you start giving back profits? Which days of the week do you perform the best or the worst? What exact event usually causes you to start feeling emotional, which is the same thing as what's your trigger? What makes you feeling on tilt, right? You need to know all of those things about yourself. You need to know your own trading behavior. You need to know your own personality, your psyche, just as much as you need to know about the setups that we talked about. You need to know these two things. One is really relative to the market, which is the setups related to the market. And the other one is a human factor. You need to control yourself, because at the end of the day, you're the person clicking the buy and sell button. You're responsible for your own trading account. So you need to control yourself. If you lose control of yourself, it doesn't matter how good or how successful your setups are. The person clicking the button is going to be swinging up and down. So this is just some examples of my own behavior. I make most of my profits within the first 2 hours of the open. So usually that's where I should allocate more size. I start losing money after about 11:30 a.m. So I start taking a break midday during lunchtime, especially because I'm gonna lose money during the midday. So why stay around for that? I usually do worst Monday and Friday, so I'm extra patient on those days, or I try to be. And my emotional trigger is that when I see my thesis was right, I got stopped out 10 seconds before the trade worked out. So that's what triggers me to start feeling emotional. So I have this rule of after red day, I size down to focus on building my confidence back. So these are the rules, and just some of them. I have even more rules that pertain to my own trading behavior, because I know that in the past, if I don't have these rules, these are the reasons or the factors that cause me to give back profits, to lose money, right? So you want to kind of control how you lose money too, right? You want to try to be away during the time you lose money and kind of be aware of those emotional events that's going to cause you to lose money. You need to know yourself very well to day trade, to be in this trading business. Okay, so key takeaways from today's presentation before we go to Q&A. If you want fast money, if you're lazy, if you want handouts or alerts, you should probably not be in this game, right? I think we all start out, most of us start out, sure, wanting the fast money, myself included. But like I said, if you don't snap out of that sooner or later, either you're gonna, lose enough money where you cannot be part of the market anymore, or you're gonna continue in that cycle of small wins, bigger losses. Trading requires hard work and time, so you need to start taking responsibility for your own account, start learning, tracking, and backtesting setups and your own behavior. You have to accept the fact that you will lose money many times, and you will continue to do so. I still lose money, right? But you need to trade small and treat your small losses as market tuition to absorb screen time and experience. So that's basically kind of, you need to, at least when you're first starting out, the first 1 or 2 years, you need to treat that as going to school, as going to college, right? You pay, trade small until then, but you should accept the fact that you're going to pay, $10, $50, $100 per day, right? To lose in the market in order to learn how to trade and profit later on. It's so important to kind of, treat your initial losses early on as market tuition. That's very important, because if you kind of just give up on month 2 or month 6, you'll never get to that point where you have enough screen time to kind of start digesting everything down the road, let's say in a year. You need to give yourself the luxury of time, and that's something you have to allow yourself to do. And that's the reason you want to trade small until then, right? You need to learn first and profit later. Many things you learn your first 1 or 2 months will not make any sense. Like obviously, it's like learning a new language, right? Until you've collected enough screen time to digest the material, right? Trading, how to read charts, how to analyze everything is really like a new language, right? When you start learning, when I first started learning English, I don't jump straight to reading Harry Potter, right? I need to learn how to read English first. And how I learned English, it took, obviously months and years. But now I can read Harry Potter perfectly, I hope. Well, maybe not perfectly. But you can, now I can read. But until I get to that point where I learn the language enough to read a book, I will not I cannot just jump straight from ABCD to reading Harry Potter, right? That's kind of the point I'm trying to make. You need to learn first and profit later. You need to learn how to read the market with your first 6 months or a year or even 2 years, and start capitalizing on what you've learned. But most people don't get to that point because most people give up or they blow up after 6 months and they haven't even learned the language yet. They haven't even gotten started. And just kind of repeat what I said earlier, 90% of traders fail because they spend 90% of the time chasing 90% of all hot stocks out there, right? You need to narrow down your stock selection and your setups and your trading behavior. Setups and strategies may change, and they do change, but the skills you learned from observing the market, your patience, your discipline, and the rules are what's going to allow you to adapt and change with the market. The strategies may change, right? Over the years, certain setups and certain things don't work 100% as they did on my year 3 or year 4. But I've learned to adapt using the same skills we talked about earlier. Observe from the market, work backwards to backtest, and that's how you adapt. Adapting in the market is a skill, right? No one setup and strategy is going to work exactly 10 years from now. Right, the setup I showed you earlier, we may have to go in and tweak it in 6 months or a year because markets change. But you will have the skill and the patience and discipline to adapt with the market. And that's how traders survive, right? You need to have the same discipline that you had in year 4 and the same discipline. You need to use the same discipline in year 5, 6, 7, 8, 9, 10 to adapt to the market. Okay, so learn first, profit later. You guys can learn more about me on my YouTube channel. I have a day trading for beginners playlist. I just reordered everything yesterday, so you can take a look from that. If you go to YouTube, search Humble Trader, you will find